Welcome to our deep dive on financial simplicity and why portfolio rebalancing is critical for long-term wealth. In this video, we will explore how most investors fall into portfolio bloat, why rebalancing is not market timing, and how simplicity often beats complexity. We will also provide practical rules you can follow to rebalance with discipline and reduce emotional errors. Let us begin by setting the big idea and roadmap for today. First, here is the core message. Simplify your portfolio and rebalance consistently to manage risk. Rebalancing is not a timing strategy. It is a risk management exercise that keeps your asset allocation aligned with your plan. Complexity adds fees, redundancy, and psychological strain. Simplicity helps you stay the course. Next, here is our agenda. We will begin with the problem of portfolio bloat. Then we will define rebalancing and what it is not. We will look at a simple 70% stocks and 30% bonds example. After that, we will show how to set up a simple portfolio and apply clear rules. We will review a case study, discuss pitfalls including fees and taxes, explore automation tools, test your knowledge with brief quizzes, and wrap up with a summary and next steps. To begin, let us define portfolio bloat. Many investors accumulate too many overlapping funds and individual stocks. This redundancy hides risk, complicates decision-making, and often increases fees. Complexity adds friction and encourages emotional trading mistakes. A useful rule of thumb is that if your portfolio requires intricate spreadsheets just to understand, it is likely too complex. By simplifying, you reveal your true risk, reduce costs, and make it easier to stay disciplined. Moving on, this diagram illustrates a classic 70% stocks and 30% bonds target allocation. The pie shows two slices, a larger stocks slice at 70% and a smaller bond slice at 30%. This target allocation defines the intended risk level. The purpose of rebalancing is to keep the real portfolio aligned with this target through time. Now let us clarify rebalancing. Rebalancing is a risk management exercise, not an attempt to predict markets. It enforces discipline by selling assets that have outperformed and buying those that have underperformed to restore the original target weights. For example, if your target is 70% stocks and 30% bonds, and a bull market pushes you to 80% stocks and 20% bonds, you would sell some stocks and buy bonds to return to 70-30. If you ignore drift, you allow markets to redefine your risk, which can lead to larger drawdowns during downturns. To avoid this, set clear rules, such as rebalancing once a year, or whenever an asset class drifts 5% or more from its target. Furthermore, here is a simple drift in action table. For a target of 70% stocks, a 5% drift threshold means selling stocks if they exceed 75%, or buying if they fall below 65%. For a target of 30% bonds, the same 5% threshold applies. Sell bonds above 35% or buy bonds below 25%. Perform at least an annual check and execute only if the rule is triggered. When possible, do rebalancing in tax-advantaged accounts to reduce tax impact. Next, let us walk through a straightforward setup. First, consolidate your holdings into 2 to 4 broad, low-cost index funds, such as Total Stock Market, Total International, and Total Bond Market funds. Second, define and document your target weights, for example 70% stocks and 30% bonds. Third, automate your contributions so they approximate your targets. Fourth, choose a rebalancing rule, such as rebalancing annually, or when allocations drift by plus or minus 5%. Fifth, when possible, rebalance in tax-advantaged accounts to avoid tax friction. In taxable accounts, use new contributions and dividends to move toward targets and minimize realized gains. Finally, formalize all of this in an investment policy statement and follow it consistently. Moreover, this flowchart shows the rebalancing workflow. You start by checking current weights and comparing them to your targets. If drift is within your threshold, you do nothing and continue contributions. If drift exceeds your threshold, you calculate necessary trades, sell overweight assets, and buy underweight assets. You then confirm the new weights to ensure alignment with targets, and finish. When possible, conduct trades in tax-advantaged accounts, and in taxable accounts use new contributions and dividends to minimize taxes. Let us consider a simple, Case study. You start with $100,000 at a 70% stocks and 30% bonds target, which is $70,000 in stocks and $30,000 in bonds. After a strong year where stocks rise 25% and bonds rise 2%, stocks become approximately $87,500 and bonds approximately $30,600. Your allocation is now roughly 74% stocks and 26% bonds. After a second strong year with the same returns, stocks rise to about $109,400 and bonds to about $31,200, creating an allocation near 78% stocks and 22% bonds. At this point, you rebalance back to 70-30 by selling some stocks and buying bonds. This locks in part of the stock gains and restores the intended risk exposure. In a subsequent downturn, the portfolio avoids the larger losses it would have experienced if it had remained at 78-22. In contrast, simplicity emphasizes a small number of low-cost index funds, clear targets, lower fees, fewer errors, and less stress. It pairs with a disciplined, rebalancing cadence. Overtrading, on the other hand, involves many tickers and sector bets, constantly shifting targets, higher costs and tax drag, more time commitment, more stress, and impulsive, emotion-driven decisions. The simple approach makes it easier to stay consistent through market cycles. Additionally, radical simplicity delivers multiple benefits. It lowers all-in costs, removes overlapping holdings, clarifies your risk profile, reduces decision fatigue, enables easier automation, and improves the odds that you remain invested through downturns. Here is a quick knowledge check. Which statement best describes portfolio rebalancing? Option A, a strategy to time market tops and bottoms. Option B, a forced risk management process to maintain target allocations. Option C, a method to maximize short-term gains. Option D, a way to avoid holding bonds entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Rebalancing is a forced risk management process designed to maintain your target allocations. It is not market timing, it is not focused on short-term gains, and it does not exist to avoid bonds. Next quiz question. A practical rebalancing rule from this video is which of the following? Option A, rebalance every week, regardless of conditions. Option B, only rebalance when stocks crash. Option C, rebalance annually or when an asset class drifts plus or minus 5% from its target. Option D, never rebalance if winners keep winning. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. A practical approach is to rebalance annually or when any asset class drifts by approximately plus or minus 5% from its target. This rules-based method reduces emotional decision-making and helps keep risk on target. Now be aware of these common pitfalls. Rebalancing too often can increase costs and taxes. Ignoring taxes can lead to unnecessary realized gains in taxable accounts. Constantly changing targets after every headline undermines discipline. Holding too many funds makes risk less visible and delays action. Finally, not having a written investment policy statement means decisions are more likely to drift away from your plan. To put cadence into context, this timeline shows a typical year. In January, you confirm targets and your investment policy statement. Quarterly, you check drift without taking action, unless the 5% threshold is reached. At year-end, you have your primary rebalancing window. Throughout the year, you direct new contributions and dividends toward underweight assets. Around tax time, you review asset location and prefer making rebalancing trades in tax-advantaged accounts. Additionally, leverage tools and automation. Set up automatic investments aligned with your target weights. Use threshold alerts or tracking apps to monitor drift. When appropriate, consider all-in-one funds, such as target date or balanced funds that handle rebalancing internally. Perform most rebalancing in tax-advantaged accounts. In taxable accounts, use ongoing cash flows to reduce realized gains. Before we wrap up, an important disclaimer. This content is educational and not financial advice. Investing involves risk, including the possible loss of principal. You should consult a qualified professional for advice specific to your circumstances. Past performance does not guarantee future results. As a brief recap and a concise list, emphasize 5 points. First, keep it simple with 2 to 4 low-cost index funds. Second, set clear targets such as 70% stocks and 30% bonds. Third, let rules beat hunches by using annual or plus or minus 5% drift rebalancing. Fourth, automate contributions and alerts. Fifth, minimize taxes by preferring tax-advantaged accounts and using cash flows in taxable accounts. In summary, rebalancing is a form of disciplined risk control rather than market timing. Simplicity reduces fees, stress, and mistakes. Write clear rules, automate as much as possible, and rebalance on a defined schedule. Over time, the lazy but disciplined approach often outperforms the frantic and overanalyzed one. Finally, thank you for watching. If this video helped you, please like, share, and subscribe for more content on calm, rules-based investing. In the comments, share your target allocation and your rebalancing rule. We look forward to your thoughts.